And here we have a profit and loss statement. Look on the left-hand side. Revenue is our sales and our expenses. Take our expenses of the organization off, we're going to have our net income, whether it's a loss or a profit. When some people refer to net income, they actually mean net profit. And that's why it's called either an income statement or a profit and loss statement. Keep it simple. Revenue minus expenses equals net income. Profit. Covers the period quite often, an annual one, a monthly one, a quarterly one. But basically, if our revenue is more than our expenses, so if revenue, the money coming in is more than the money going out, then our net income or it's going to be profit. We're going to be a profitable organization. And it results in a net income, not a net loss. Okay. This really explains a little bit more about the balance sheet in its own right. Okay. Now, I'm going to start for the left here, which actually enables us to get to the retained profit. So look, sorry, I'm going to start on the left on my expenses. Look to the right for a second. Sales minus cost of sales gives us our gross profit. Gross profit minus the daily expenses gives us our operating profit. And then we get our interest and our tax. We get net profit after tax, dividends, and retained profit. That's the money we keep within the business. So coming to the left here, just follow my pointer across the screen. This explains it really nicely. You know, our starting point of a P&L, you know, our starting point for profitability is sales. And, you know, if you also think about the cost of the sales, well, of course, we've got to take the cost of the sales off. So, and that could be a few things. That could be the raw materials that we buy as part of manufacturing. Sales minus cost of sales gives us our gross profit. But we also have a number of expenses for the business. Lots of expenses for the business, actually, which have to go on top of the cost of sales. Then that gives us our operating profit. It's because what we've done is we've taken all of the taxes off, sorry, all of the costs off, apart from our interest in tax. And you'll see on some reports, you'll see profit before income and tax, PBIT, or profit before, sorry, net profit after tax, NPAT. Different people use them for different reasons. Obviously, governments are interested in interest and tax. And that gives us our net profit. So when we take off the interest and tax, it gives us our net profit after tax. When we take off our dividends, so dividends are what we pay out to shareholders, we get you know, we pay from the profits of the business. We want to give shareholders a return, right? That's what gives us, once we've done that, that gives us our retained profit. So you can see from the sales how we take chunks out of the sales in terms of our costs and how we group our costs to get our retained profit. You know, our operating profit, some people think, okay, the operating profit, it's positive, so that's great. Well, it depends how positive it is actually, because you've got interest and tax to come off that. You've got dividends. No one's going to invest in your organization if they're not going to be making a profit, right? That's why, well, that's why we're all in business. So just think of that as we go through. But that's really simplistic, and I do like it because it's easy to understand. It's a really kind of simplistic way of looking into the profitability of the business. Again, right hand side, sales minus cost of sales gives us our gross profit. Gross profit minus expenses gives us our operating profit or our net profit. Take off the interest and tax from that, we get our net profit after tax. Take off the dividends from that, we get the retained profit. And in Australia, for example, there's taxation then on a corporate taxation on your retained profit. So the businesses that I run, to be frank, I aim to make it not really make a profit at the end of the year. It's my business, so I can pay myself a salary from it. But I aim to not really make a profit at the end of the year, because if I do, and I keep that profit within the business, I'm going to be taxed on it. So I'm actually financially better off to take that out as income tax and pay tax on that. So these are things to think about when running a small business or a large business for that matter. Okay. Accounting standards. Don't want to talk about accounting standards too much, but essentially we've been talking about it as a whole the last few weeks. Accounting standards are really what is the norm? What do we really need to do as far as accounting is concerned? Well, you know what? Our financial statements, as we've said many times, should consist of the following: a statement of the financial position. What's that? That's the balance sheet, right? A statement of comprehensive income, profit and loss rate. A statement of changes in equity. So how has ownership changed over the period that we're looking at? And a statement of cash flows. We also, so that's what a financial accountant, finance department is going to put together for reporting purposes, each of those statements. Also, they'll come with a set of notes, including a summary of the significant accounting policies. Makes sense, right? And by definition, then the nature of the information required is established. It's based on what should be included in the statements for public knowledge. So certain industries, certain businesses, they need to disclose stuff legally. We've talked about open disclosure or total disclosure. And it needs to be based on the rules determining recognition, measurement, and valuation. So this is all about measuring a business. This is all about understanding a business, but also this is all about reporting a business as well to the authorities that need to be reported to. Usually there's legislation in most countries, well, I think probably in all countries, there's legislation surrounding what we need to do and what we need to report. And as a result, it could actually change by country in terms of how we report or what we report. But generally, we're reporting the same level of things. But of course, we need to stick to the rules. We need to be compliant with legislation in the company that we operate. So this really is the final part of this particular section. What have we done? We've introduced the practice of bookkeeping as a starting point for financial reporting. We've looked at bookkeeping principles and discussed the role within financial control. Remember the discussion about financial management and accounting management that we've been talking about. We've talked about the concept of double entry, the balance sheet. We've talked about the distinctions between bookkeeping and accounting. Remember, bookkeeping, that's about recording transactions. Accounting, financial accounting, that's really about, or managerial accounting, that's really about starting to make decisions and reports around the business as well. The importance and purpose of financial statements that make up the formal accounts of a business have been described. We've talked about key accounting concepts, and we've focused on the balance sheet and the profit and loss as the two key statements with brief details of cash flow that are really needed for any business. And we've looked at how we can start to prepare these and who it's relevant to and all this type of thing as well. So that is really what I want to talk about in this section. And we've started to take a look at ratio analysis. We'll come back to this. We'll also come back to it in the assignment. We also look at, you know, we're talking about UK standards here, but generally, as I said, applicable across the world.